This video is about 7 mistakes that I made in retirement. And this is regarding finances. And I'm going to share this with you, and I'm going to end with a powerful insight about mistakes that we all have made and about missed opportunities that we've all done. So make sure you stay tuned to the end. Okay, the first mistake that I made about investing was that I thought someone else had the answer. And this is about investing, about retirement planning, about how we'll live in retirement. I thought that a financial advisor had the answer. I thought an influencer had the answer. Someone else had an author of books had the answer. A seminar leader had the answer. I thought someone else had the answer for what we needed to do so that we could support ourselves after we stumbled into early retirement around midlife. I thought that one person had the answer. And what I learned was that was just not the case. What it took was for me to buckle down and become a better investor and to really think outside the box and not just do what was being promoted and taught to everyone else. The answer is there are really no shortcuts, in my opinion, to really understanding how investing works. Whether or not you work with a financial advisor, it's really important so that you can make wise investment decisions. And I don't think that someone else has all the answers simply because it's you, it's your life, it's your money, it's all your circumstances and situations, and you are the leader of your money. If you work with an advisor that you chose because you didn't really understand investing that well and your money is lost, you're still going to pay the advisor and you're the one that's going to lose money. So regardless of what you do, whether or not you delegate your wealth management, it's important to understand how investing works and really embrace your own investing journey. Okay, the next thing that I did, mistake I made in retirement, and these are really in leading up to retirement and planning for retirement, and that's that I focused on long-term average returns. You know, like 20 years ago, I said, oh, okay, the stock market averages 10% annual returns. That's a long-term average. It was after I really relied more on our investments where I realized how important it is to understand that the stock market varies from year to year in investment returns, and some years are up, some years are down, and those movements can be quite different from year to year. The next mistake I made in retirement, or in planning for retirement really, is that I didn't manage risk well enough in the 2000s decade. And I didn't do that both alone in the accounts I was investing, as well as in the accounts that financial advisors were managing for me. And I worked with several different financial advisors over the 2000s decade. I thought that financial advisors got you out of the market before your accounts declined if there was a serious bear market. I thought that a particular financial advisor I hired would get us out of the market before our accounts declined 50%. That was why I selected that particular advisor. I was told by the person that recommended them that this particular advisor got their clients out of the market during the tech bust. And so I thought, perfect, this is somebody that will really and truly work with our accounts and keep our money safe and get us out of the stock market before there's a serious decline in our accounts. I was wrong. It was a big mistake that I made. Let me say that some financial advisors work that way, attempting to get you out of the market before there's a big decline, and others don't. Others are simply based on asset allocation, buy and hold investing. Watch my video on the 4 real types of financial advisors so you can understand there's nothing right or wrong about any of these. They're just different types of advisors, and a mistake I made was not really understanding these 4 types of financial advisors so I could hire the right type of financial advisor. Okay, the next mistake I made was that I didn't take on enough risk. So first I took on too much risk, and both alone and with financial advisors. But then because of that lesson, I didn't take on enough risk. I became very risk averse. And this is exactly what happens to investors. And one of the things that I learned the hard way to not do, to actually make investment decisions, not emotionally, but from sound principles. I've done another video on how I invest now. All of this led me to the current investing methodology that I began using several years ago. I've outlined this in another video called the Allocate Smartly Review that I use for a lot of our liquid assets, a lot of our investments. I'll try to remember to put a link to it, but if I forget, if you just search Allocate Smartly Review, I will probably come up near the top of that search. And you can watch that video explaining how I now manage all of this and have done so for several years. Okay, the next mistake that I made was I didn't act on opportunities that I saw that I knew were really great opportunities. Let me give you an example of this because you may have done something similar. In the mid-1990s, we were visiting Houston. I saw that condos on Bering Drive, and that was where I had bought my first little real estate property in my mid-20s. I saw that the prices were really, really low. There had been a major real estate correction in Houston. The market was just devastated, and I could pick up those condos for less than I had paid for mine, considerably less. I could rent them out profitably. They would have cash flowed. Not only that, they went on to triple, a little bit over triple in value over the next decade. I didn't buy them. I could have bought them, but I didn't buy them mostly because I lived overseas at the time and I had a young family, and it would have been a little bit of a hassle. Would it have been worth the hassle? Yes, it would have been worth the hassle. But I think the other reason I didn't buy them, as well as not act on other opportunities I've seen, was a lack of confidence. So look back and think about opportunities that you maybe could have taken that you haven't taken. And I'm getting ahead of myself. I'll talk more about that in just a second. But that was one of the mistakes that I made in planning for retirement. And this was certainly way pre-retirement for us. But it would have had a huge impact on our retirement if we owned all those rental properties now, or even if we had bought them and sold them after they tripled in value, of course. Okay, the next mistake that I made in retirement, and really this was more after we stumbled into early retirement, I didn't have enough dry powder when it would have had a huge impact. And that was specifically in March of 2009. I remember looking at CNBC, which I used to watch, and I said, I think the market has hit bottom. It was that very day I was snow skiing. I remember it. I remember where I was standing, and I knew it had hit bottom, but I didn't have dry powder. I didn't have money to put in the market because of what I discussed earlier. I thought that these financial advisors I had hired would get me out of the market, and I would have dry powder when the time came to buy stocks super, super cheap. That was an incredible opportunity. Those opportunities come along about once a decade for investors, so only a few times during our investing lifetimes they can have a major impact on your ability to retire, to support yourself, for the duration, and to have financial independence. So that was a big one. It's having dry powder. And that is another reason that I invest using the technical strategy I use that I put together at Allocate Smartly. I actually put together my own strategy based on 3 professional strategies that I analyzed on Allocate Smartly. And again, you can check out that video to learn more about how I've sort of deal with this now, so that I do plan on having dry powder, and I have some dry powder anyway now. I think I'll always have a little dry powder from now on. Okay, so now this is what I wanted to share with you. You've seen several mistakes that I've made myself over the decades in investing and planning for retirement, handling investments in retirement. If you think back though on the things that you could have done that would have had a huge impact on your financial success, just like me talking about buying those properties in Houston when they were so cheap. If you think back about them and you didn't do them, this means that you have the potential inside of you to build wealth. It means that you have the ability to spot opportunities to build wealth, that you have the ability to have that dry powder available because you have an awareness of it. And if you have an awareness of it, you have the ability to do it. Most people just don't even know what having dry powder means, or don't really even think about buying real estate at devastated prices, cash flow real estate that they can later sell. We're not encouraged to think in this proactive way. So what I want to share, and this is that final tip I really want to share with you, that I've realized that's really boosted my confidence in investing, and I think it can boost your confidence as well, because I've coached some of you, and I know even financial advisors that really have hung on to past mistakes that they've made with their money and or with client money. If you see that you could have done something and you didn't do it because of one reason or another at the time, that means you definitely have the potential to do it. So all you need to do is resolve the mindset that kept you from doing it before. Just develop an awareness of it. Why didn't I do that? Was I afraid? Was it because I lacked confidence? And if it's lacking confidence because of information, just learn what you need to learn. But more than likely, it's just because it was sprung on you and you don't have the confidence that you have now. And this means that you do have the opportunity to build wealth. That's what I wanted to share. And remember, retire certain.